Investing in dividend ETFs is an excellent way to earn a monthly passive income. However, finding the best ETF to invest in is a challenging task. You'll have to analyze the ETF, read financial statements and expert predictions, and much more. But don't worry, I'm here to help you as I've done this research for you guys. Hi guys, and welcome back to Glory Investing Show, and in today's video, I'm going to tell you about the top 7 monthly ETFs to earn more money. Number 7. The Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. At number 7 on the top monthly dividend, the ETF list is SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF. This ETF is based on the S&P 500 Low Volatility High Dividend Index, which is an index that measures the performance of the 50 least volatile, high dividend yielding stocks in the S&P 500. This index was designed as a benchmark for investors who want to earn income from their stock market investments. SPHD only holds about 52 stocks in total, with top holdings in Altria Group, Kinder Morgan, AT&T, and some other less familiar companies. Over the past 10 years, SPHD has given a 9.09% return per year. This means if you would have invested $10,000 into the ETF 10 years ago, your investment would be worth a little bit over $22,000, not including the dividends. Speaking of the dividends, this ETF currently has a dividend yield of 3.97%. And so, with this ETF, not only are you getting good investment returns that are near the 10.5% that the overall stock market gives, but you're also getting a high dividend yield. Now, as this is the case with every ETF, you'll have to pay what's called an expense ratio to own shares of this ETF. Fortunately, though SPHD has the lowest expense ratio on the list at only 0.30%, you only have to pay $3 per year for every $1,000 that you invest into this ETF. Number 6. PGX. At number 6, this PGX, or the Invesco Preferred ETF, PGX is based on the wait for it ICE Both AML Core Plus Fixed Rate Preferred Securities Index, which tracks the performance of fixed-rate U.S. preferred securities. What's unique about this is that preferred securities typically offer higher dividend yields than traditional fixed-income security. Now, PGX has only returned about 3.86% annually over the past 10 years, partially due to the recent downturn in the overall market. This means $10,000 invested into the ETF 10 years ago would be worth about $14,000 today. So it's not great, but you are still getting a little bit of growth. The dividend yield on this ETF is sitting at 6.11%, which is the highest on the list so far. But that does come with a slight cost. The cost is in the form of a slightly higher expense ratio coming in at 0.51%. This means that you would pay $5.10 per year in fees for every $10,000 that you invest into this ETF. Number 5. DIV. The ETF coming in at number 5 is DIV, or the Global X Super Dividend US ETF. DIV is a very popular high dividend yielding ETF that tracks the Index Super Dividend US Low Volatility Index, which is an index that tracks exactly 50 equally weighted high dividend low volatility stocks. And of the 50 stocks that this ETF holds, some of the top holdings include companies like Sabine, Kellogg, and IBM. This ETF was founded in 2013, and we can't quite measure the 10-year growth yet. However, since its inception in 2013, it's given an average annual return of about 2.95%, which means $10,000 invested into this ETF back in 2013 would be worth about $14,000 today. This ETF has a mind-blowing dividend yield of 71.15%, which is insane. In terms of this dividend yield for this ETF, it's currently sitting at 6.57% and has an expense ratio of 0.45, which means you'll pay $4.45 per year in fees for every $1,000 that you invest into this ETF. Number 4. SRET. At number 4, we have SRET, or the Global X Super Dividend REIT ETF. This ETF tracks the Selective Global Super Dividend REIT Index, which is an index that tracks the performance of the highest yielding REITs in the world. An REIT is a real estate investment trust, which is a company that owns and operates income-producing real estate. At the moment, SRET holds 28 stocks in total, with top holdings in companies including Getty Realty, WP Carey, and Capital Land. You see, REITs are legally required to pay 90% of their taxable income to shareholders every year in the form of dividends. So, this ETF has a lovely dividend yield of 8.44%, nearly 2% higher than the previous ETF on this list. But that high dividend yield does come at a price, and that price isn't a high expense ratio at 0.58%. You can expect to pay about $5.80 per year for every $1,000 that you invest into SRET. As you've likely already noticed by now, most of these dividend-paying ETFs have higher expense ratios when compared to other ETFs that follow more passive and broad market strategies like VOO or VTI. Unfortunately, that's just the price you have to pay to get higher dividend paychecks. Number 3. KBWD. At number 3 is KBWD, or the Invesco KBW High Dividend Yield Financial ETF. This ETF tracks the KBW Nasdaq Financial Sector Dividend Yield Index, which is a dividend yield-weighted index consisting of U.S. financial companies with high dividend yields. At this time, KBW is holding 40 stocks in total, with top holdings in many financial companies including Armor Residential, Broadmark Realty Capital, Ready Capital, and dozens of other finance-related companies. Now, when it comes to performance, this ETF is not a high performer, but the return is still relatively good. Since its inception in 2013, it's given an average annual return of 4.67%. This means if you invested $10,000 back in 2013, your investment would have grown to a little bit over $13,000. But where this ETF lacks its growth, it makes up for with its 11.18% dividend yield, the highest dividend yield on this list so far. But there's something else that this ETF has that's also the highest on the list, and that's its outrageous expense ratio. At 2.95%, you'll pay about $25.90 per year for every $1,000 that you invest. Number 2. QYLD. At number 2 is QYLD, or the Global X Nasdaq 100 Covered Call ETF. This ETF seeks to provide investment results that correspond to the performance of the SPO Nasdaq 100 Buy Right V2 Index, which is a benchmark index designed to track the performance of a hypothetical buy right strategy of the Nasdaq 100. This ETF has a very unique approach to earning income compared to all the other ETFs on this list. At the time, QYLD holds 103 stocks, with top holdings in top Nasdaq 100 stocks including Apple, Microsoft, Amazon, Tesla, Google, and many others. Since the ETF's inception in 2013, it's returned about 5.23% per year. So, if you invested $10,000 into this ETF back in 2013, your investment would have grown to a little bit over $16,000 today. Number 1. JEPI. JEPI, or the JP Morgan Equity Premium Income ETF. JEPI is an actively managed ETF that invests in both U.S. large-cap stocks and equity-linked notes. And the goal of this ETF is to provide monthly dividend income as well as just general exposure to the stock market, but with less volatility. And it does this by hand-selecting stocks from the S&P 500 index using a process to identify value stocks with favorable risk and return characteristics. JEPI currently holds 107 stocks, with top holdings in United Health, Hershey, and many others. Now, JEPI has one of the most impressive average annual returns on the list since its inception. It's averaged about a 9.89% return per year. This means $10,000 invested a few years ago would be worth about $12,500 today. I know that probably doesn't sound very impressive, but you also have to consider that this ETF is brand new. And if we looked at an ETF that has similar averages to JPI, but then expanded the time horizon over 10 years, the returns of JPI. It also has one of the lowest expense ratios on the list at 0.35%, which means you'll only have to pay $3.50 per year for every $1,000 that you invest. That's all for today's video. I hope you enjoyed it. If you found this video helpful, make sure you smash the like button and share it with your friends. Don't forget to share your thoughts with us in the comments section below. And while you're here, Check out these videos for best dividend-paying stocks.